All right, let's jump right into this explainer. We are taking Unilever's Q1 2026 data and throwing it straight into the ultimate valuation gauntlet. You know, as an analyst, literally nothing is more fun than stress testing a massive, global blue-chip company against the greatest investing minds in history. And that's exactly what we're going to do today.
Here's the game plan for today. We'll start with a quick company snapshot, then run it through the legendary lenses of Buffett, Lynch, and Graham before heading into the lab for some modern DCF and alternative modeling. Finally, we'll synthesize it all for a final verdict.
Okay, part 1. Company snapshot for Unilever, Q1 2026. Because you really can't value a business until you know its vital signs.
Right now, the stock is sitting at $62.74. Wall Street is currently giving it a consensus buy rating, pinning an average price target around $66.45. So right off the bat, we're looking at an expected potential upside of what, about 6%.
Looking at their actual Q1 trading statement, they just delivered 12.6 billion euros in turnover. That comes with an underlying sales growth of 3.8%. And what's absolutely crucial to note here is that this growth was volume-led, up 2.9%. They aren't just relying on hiking up prices to juice the numbers, which is a fantastic sign.
But, you know, this isn't just some sleepy consumer goods giant resting on its laurels. They are aggressively reshaping the whole shebang. They've got this massive combination of their foods business with McCormick coming up by mid-2027. That's going to make them a pure-play health and personal care powerhouse. Add in a 1.5 billion euro share buyback that just finished, a staggering 6 billion euro runway for total buybacks by 2029, and a dividend that just bumped up 3%. Management is clearly not playing around with capital allocation.
Moving on to our first guru framework, Section 2, the Warren Buffett lens. We're hunting for quality and a deep economic moat.
So Buffett loves a good economic moat, right? And Unilever's power brands are driving a really solid 5% growth. We're seeing broad-based momentum across emerging markets, too. India alone grew 7%. Now, while they didn't drop exact Q1 return on equity figures, if we assume historically high industry averages, they remain incredibly efficient. Debt? Super manageable at exactly 2.0 times underlying EBITDA. Plus, management is knocking their 800 million euro productivity program out of the park, running way ahead of schedule. So, qualitatively, yeah, it definitely ticks Buffett's boxes.
But as we know, Buffett isn't just about a good story. He wants the cash. To figure out his favored owner earnings from our data, we take their guidance of a 20% operating margin, assume standard industry cash conversions, and then we've got to subtract their stated capital expenditures, which are running a bit above 3% of turnover, and strip out about 1% for restructuring costs.
So here's the bottom line for Warren. Unilever easily passes the qualitative test, but based on those owner earnings, our estimated intrinsic value lands right around $70. Now, Buffett demands a margin of safety. If we apply, say, a 15% buffer to that $70, he'd probably sit on his hands and wait for the stock to drop to around $59.50 before actually pulling the trigger.
All right, Section 3. Let's look through the Peter Lynch lens and see if we can find some growth at a reasonable price.
Based on the numbers, Lynch would absolutely slap the stalwart label on Unilever. This is a massive, well-established business. You're not buying this expecting a crazy 50% pop overnight. You're buying downside protection, moderate growth, and a reliable dividend, aiming for a nice, steady 10 to 12% total return.
To value a stalwart, Lynch looks straight at the PEG ratio, price to earnings divided by the growth rate. Since management is guiding for 4 to 6% multi-year growth, and if we assume a standard consumer packaged goods PE multiple, we land on an estimated PEG ratio slightly above 2.0. Now, Lynch usually hunts for a PEG closer to 1.0, so you're definitely paying a premium for that stability here. Summing up the Lynch checklist, the balance sheet is undeniably strong at that 2 times net debt to EBITDA. We don't have recent insider buying data from Q1, but balancing that financial fortress against the modest growth and a borderline high PEG ratio, the Lynch-style verdict right now leans firmly toward a hold. It's a fantastic business, just not the steep bargain he typically goes for.
Let's pivot away from growth entirely. Section 4, the Benjamin Graham lens. We're talking strict, defensive, mathematical value.
Graham doesn't care about your narrative, he cares about balance sheet protection. Looking at his defensive investor checklist, Unilever is basically a fortress. Adequate size? Obviously, 12.6 billion euros in one quarter. Strong finances? Check. Earning stability and a long dividend history? Yes, absolutely.
It passes almost every single qualitative check, but it's probably going to fail on his incredibly strict historical price-to-earnings and price-to-book limits.
To find his exact intrinsic value, we run his classic square root formula, the square root of 22.5 times earnings per share times book value per share. Since our Q1 trading statement doesn't explicitly list EPS or book value, we actually have to plug in standard industry estimates for a defensive giant like this just to see where the math shakes out.
And when we run those estimates, we get a highly conservative baseline value of around $31.80. Yeah. Graham demands a massive margin of safety. And at today's price of nearly $63, this stock just gets absolutely crushed by his bargain basement mathematical threshold. For a strict Graham investor, this is a clear avoid or sell.
But honestly, this brings up a really fascinating question. Do these historical, asset-heavy frameworks like Graham's completely miss the mark when valuing modern cash generation and massive global brand power?
Let's find out. Section 5. DCF and Alternative Models. Time to step into the lab.
Building a base case discounted cash flow model, we take management's multi-year sales growth guidance of 4 to 6% across a 5-year forecast period. We assume a weighted average cost of capital, our discount rate, somewhere between 7.5 and 8%, and a perpetual terminal growth rate of about 2 to 2.5%. Running those sensitivities gives us a fair value range between $65 and $68, which, if you remember, lines up perfectly with those Wall Street consensus targets.
Now, let's run another model. Standard PE comparables put it right near sector averages. But since returning capital is such a huge part of Unilever's DNA, we really have to run a dividend discount model, or DDM. They just bumped their ADR quarterly payout to over 54 cents. That's about $2.18 annualized. Assuming a conservative 4% dividend growth rate and a 7.5% cost of equity, our DDM spits out a fair value of exactly $62.28. I mean, that is literally right on top of today's trading price.
All right, Section 6. Synthesis and Final Verdict. We've run the gauntlet, so what does it all mean?
As an analyst, you always have to weigh the fundamental strengths against the macro risks. On the plus side, you've got this unstoppable momentum in emerging markets, like that 7% growth in India, plus those massive power brands and a ridiculous €6 billion buyback program. But you simply can't ignore the headwinds. A brutal 7.7% negative currency impact is eating into their top line right now. There's significant execution risk tied to integrating McCormick by 2027, and the stock is trading at elevated historical multiples.
So, bringing it all together, Buffett and Lynch both point to a hold, wanting just a slightly better margin of safety. Graham, being Graham, says sell. But our modern DCF and dividend discount models put the stock squarely in the fairly valued camp, right between $62 and $68. So at $62.74, our final verdict for Unilever is a brilliantly defensive hold sitting exactly at fair value. But I'll leave you with this one thought to chew on. Will that upcoming McCormick integration in 2027 be the exact catalyst needed to finally break this defensive stalwart out and push it into pure growth territory? Keep your eyes on that closing date.